Welcome back to What's Hot, What's Not C.R.E., your daily pulse on commercial real estate in America. It's Monday, February 9th, 2026. Today, the freshest multifamily data. Occupancy just ticked up for the first time in 6 months. Okay, let's get into what's hot. We saw a big and frankly much-needed shift this month. Apartment occupancy nationally rose to 94.7% in January. That is the first increase we've seen in 6 long months. Alongside that, effective asking rents were up 0.2% month over month. Again, the first positive movement since last summer. This isn't a fluke. Demand has now exceeded supply for 2 consecutive quarters. Absorption is finally catching up to the historic delivery pipeline. And the real story here is the suburban recovery. Suburban markets are absolutely leading the charge. Vacancy in the burbs is sitting at 6.9%, which is a healthy contrast to the 7.6% we're seeing in urban cores. What's driving it? Affordability. The for-sale housing market remains tight, pushing would-be buyers into the rental market, and they're choosing the suburbs. Plus, corporate relocations and steady in-migration are keeping that suburban demand incredibly strong. Investors are noticing. We saw a staggering $165.5 billion in apartment transactions in 2025, which marks a 3-year high. Despite that volume, cap rates are holding steady at 5.7%. There's no compression yet, but stability is the headline. Regionally, the Northeast is seeing the strongest rent growth, around 4 to 5% annually, largely because of limited new supply. The Midwest is also a steady performer, posting 3 to 4.5% growth thanks to a combination of affordability and very little new construction. Now, for what's not. The Sun Belt is still grappling with that oversupply hangover. Vacancy rates in major Texas metros like Austin and Dallas are still well above the national average, as they continue to digest all those new units that came online. The South and West are where we're seeing the most pronounced rent cuts. Think Phoenix, Denver, and Charlotte. Those markets are still soft. Let's put some national numbers on that. The U.S. finished 2025 with a vacancy rate of 6.7%. That's up from 6.4% the year prior. And like I mentioned, urban rental vacancy is at 7.6%. That's the highest gap between urban and suburban performance since before the pandemic. So even with the positive month-over-month rent bump, effective rents are still down 0.4% year-over-year nationally. We have momentum, but we are not out of the woods. Why? Because new deliveries are still elevated. Estimates for 2026 range anywhere from 260,000 to 430,000 new units. The under-construction pipeline is shrinking, but it won't provide full relief from supply-side pressure until late 2026 at the earliest. So, your investor takeaway. The January occupancy uptick is a real signal. It's the first green shoot we've seen in half a year. Second, suburban markets are clearly outperforming, so follow the tenant demand. The Northeast and Midwest are offering the best rent growth fundamentals right now due to that limited supply. For the Sun Belt, patience is required. You'll likely need to wait for absorption to catch up, probably in the second half of this year. And finally, that transaction volume hitting a 3-year high shows that institutional confidence in the sector's income fundamentals is still very, very strong. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcr.com to learn more and subscribe to our newsletter.